Where we're going. Yep.
Hey guys, happy New Year. Belatedly, I guess. Can you still say that? I don't know. Denny, happy New Year to you.
Happy New Year to you, Brian, traveler
Well,
in
yeah.
my neck of the
Well,
woods.
I know I am. I'm right down the road in Delaware, at my mother-in-law's house.
There you go.
Yeah,
Very
it's a
rarely
busy
does
time
this
of year,
happen.
bouncing all over the place visiting family before we head back overseas to where we spend most of the year. But it's so much fun getting to reconnect with my roots here in the States, see family, friends.
And I look to get away from. No, I'm just kidding.
Yeah, don't let Tara hear you say that.
No, 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 no. I'm just
Denny's
kidding.
daughter is a team member of ours at Spark Rental. So anyway, Denny, what are we talking about today?
We are going to talk about the math to millions and what it takes to become a millionaire in 10 years. And if you're looking up and being like, oh, really? I've heard this before. It can happen. And quickly, we're going to show you a few ways that it can happen. So, with that, Brian, let's talk about some of this stuff. Well, first of all, please let us know where you're tuning in from. Um, the, if you have any questions or comments, pop them right in the chat. And if you like what we're talking about, if you wouldn't mind giving us a review, that would be awesome.
Please.
Um, so, Brian, let's start off with average asset returns and how they work. Can you start us out on that?
Absolutely. So this is one of those things, building wealth, becoming a millionaire. It's simple, but it's not easy, right? I mean, the math here is really simple. The numbers, what you have to do, it's all simple, but the actual saving and setting aside money every month and investing every month, that it takes discipline, right? So simple, but not easy. So there are two factors that impact how quickly you can build wealth. One is how much you invest every month, and the other is the average rate of return, the return on investment that you earn on your investments. So you can boost the amount that you invest every month by growing your savings rate, right? The percentage of your income that you put towards savings and investments. And as for your return, that depends on your skill as an investor and what you invest in. So let's talk a little bit here about the different average returns on different assets. Average return on bonds over the last 100 years or so, at least in the US, is around 5%. The exact number is around 5.3%. But of course, it depends on the type of bond. Treasury bonds pay very little on average. Junk bonds pay a lot, but they come with a lot of risk. So, we're obviously generalizing here. But average return on bonds, a little over 5%. Average return on stocks, at least if we're looking at the S&P 500, is a little over 10% going back to its inception in 1926. Now, if you look at different regions around the world, that number is usually a little lower. If you look at different types of stocks, it can be lower, but we're just going to keep things simple. So we're going to call it 10% average return on stocks. Average return on residential rental properties, that is a little less clear, right? There's not like one simple stock index that we can track for that. But you're looking at, Denny and I have been in this industry for 60 years between the two of us. We can tell you firsthand that you're looking at between 6 and 12% total average annual returns. That includes both cash flow and it includes appreciation for the property. So
I do want to intercede, though.
please.
There's a work part with that comes
Oh, yeah.
into those returns too. So you're putting some, strength and time and
Yeah, no,
yeah.
that's a great point. Like what we're talking about here is just the financial returns, but there's more than just a financial investment in residential rental properties. There's also a labor investment, and not just a labor investment to buy and manage properties, but also it takes work to learn the skills and knowledge that you need to be able to do it in the first place. So you need to put in tens or hundreds of hours worth of work just to learn what to do before you ever buy your
Mhm.
first property. So that's a great point, Denny. Thank you for for throwing that in there. And then the average return on private equity real estate investments, so passive real estate investments, real estate syndications, private equity real estate funds, you're looking at 15 to 25% on average, sometimes 30%, sometimes a lot more, and of course sometimes less. I mean, they come with risk; they can lose money too. But average return on these is in the high teens, low 20s range for people who know what they're doing. Now, if we're going to look at how much you need to invest every single month, if you want to reach $1 million net worth within 10 years, here are the numbers for that based on the returns that you're earning. So if you are earning an 8% average annual return, you need to invest around $5,700 a month to reach $1 million in 10 years. If you're earning a 10% average return on your investments, you need to invest around $5,150 a month. If you are earning 12% average returns, you need to invest around $4,700 a month to become a millionaire in 10 years. And if you are earning an average of 14% annual returns, you need to invest around $4,250 a month. Again, to hit that 7-figure net worth, to join the 2 Comma Club within 10 years. So not trivial amounts, but also not like shocking amounts either, right? Like
Right.
these are not amounts that are way beyond what any of us can conceive of, right? So not trivial amounts, not easy, depending on how much you earn, of course, but also not like inconceivable sums here. So, Deni,
You know what? I just want to, a lot of people are very young and, as long as you're doing something. So maybe it's not the $5,700 a month, but as long as you're doing something to get towards that goal, it's still getting there. And the more you do, you'll see, the more you'll be able to do.
yeah, just get started, right? You don't need to have it all figured out right off the bat, and learn how to invest for higher returns, right?
Yes.
You know, bringing this back full circle to how we started, the higher return you can earn on your money, the less you need to invest every month. So learn how to invest in passive real estate investments, in real estate syndications. This is exactly what we do in our investment club every month. We all get together and we talk about a bunch of deals. We pick one, and each person can invest small amounts in it. So, and there's other ways to learn this too. You don't have to join our investment club. Uh, you can go take courses. You can go to seminars and weekend retreats and all that stuff, but learn how passive real estate investing works. It does not take nearly as much skill or knowledge as active real estate investing, as going out there and buying properties yourself. Passive real estate investing, way easier, and as far as I'm concerned, higher returns. So, Denny, let's talk about other ways that people can accelerate on this path to building wealth. How can people get there faster?
One is you're going to grow your savings rate.
Yep.
So the more you're putting away in better places, the bigger your returns are. And
Mind the gap, as they say. Grow that gap
yeah.
between what you spend and what you earn.
And Brian, tell us about infinite returns. You explain that better than I do.
Oh yeah, well that's a fun concept in real estate. The idea behind infinite returns is you invest a certain amount of money in a property or in a passive real estate investment, and then after a certain amount of time, you get your initial investment capital back, but you keep your investment in that property. So the classic example is you buy a fixer-upper rental property, you renovate it, you rent it out, and you refinance it. And when you refinance, you pull out all of your initial down payment and closing costs. So all the initial money you put into that, you pull it back out of the property when you refinance. So you have $0 invested in that property now, but you keep that property, right? So you still own the property, you're still earning cash flow on it. It keeps appreciating in value every year, but you can take that money that you had invested in it and you can turn around and invest it in other places. And you can keep doing that same cycle over and over and over and over again, right? You can also do this with passive real estate investments. So you invest in a real estate syndication deal and the sponsor renovates it, they raise the rents, and then they refinance it and you get your initial investment back, but you keep your ownership percentage in that big apartment complex or whatever type of property it is. So you can keep reinvesting the same investment capital over and over and over again. It can keep working for you. And every time you reinvest it, you add another property to your portfolio or another real estate syndication deal in your portfolio. So it's a great way to put the same money to work many, many, many different times. And there's no limit to the return you can earn on that investment capital because you can keep reinvesting it repeatedly. So we'll put a
Get a
link to an
clue.
article explaining that
Yes.
in the show notes in the comments here. Um,
That blew my mind with the passive real estate. I mean, I've seen it with hands-on real estate investing,
yeah.
but the way it worked with the passive, that blows my mind.
Oh,
And
it's so
it's
much fun.
getting, yeah, it's unbelievable, actually. So let's talk about getting rid of the tax bill.
Well, right, because the less money that you have to pay Uncle Sam, the less money that you lose to Uncle Sam, the more you get to keep for yourself and invest, right? So that money can then go, instead of putting it towards taxes, it can go towards your monthly investments. Now, one easy way to do this is to max out your tax advantaged accounts, right? Your IRA, your 401k. That's an easy way to do it. I personally spend most of the year overseas, so I get to take advantage of the foreign earned income exclusion. So the first,
Mhm.
it's around $115,000 that I earn is tax free. Same goes for my wife, so that doubles it to 230 for us, and that exact number changes every year, but it's around there. You can also do what's called a lazy 1031 exchange with passive real estate investments, with real estate syndications, where in the initial year that you invest, you get a huge tax write-off for depreciation because you get all this accelerated depreciation with real estate syndications, which is a whole nother story. But so the exact reasoning behind it is beyond the scope of this episode. But you get a big tax write-off in the first couple years that you own a real estate syndication, and over time that gradually disappears. But when you get a deal that pays you back, right? The property sells, you get your big profit payout in that same year. Just go out and invest in a new real estate syndication, and the tax write-off you get for that new syndication, that accelerated depreciation write-off you get for the new investment, wipes out all the taxes you owe, at least on, maybe, hopefully it will wipe out all the taxes that you owe on the profits from the last one. So you don't have to worry about going through the full 1031 exchange with the custodian or
Oh my God. Yeah.
the QI, right? Qualified intermediary,
Yeah.
and the time restrictions on that. You have the 45-day rule and 185 or 180-day rule, and there's all these government boxes you have to tick to actually do a 1031 exchange. So that's why they call this a lazy 1031 exchange, right? So you make a passive real estate investment. A few years later, it sells and it pays you out. You get your profits. All you have to do is just invest in a new real estate syndication within that same year, and you can keep paying it forward without having to jump through all the normal hoops of a 1031 exchange. So it's a fun, easy way to do it, without all the government crossing of T's and dotting of I's.
Right. And how about higher yield accounts? Can you talk a little bit about like ground floor, which, some people may have heard of, concrete, things
Yeah.
like that?
So real estate investors ask us all the time, where do you park your money when you're waiting for a deal to come along, right? Because real estate investing, you don't always know when a deal is going to come along that you like. So you can have a lot of money just sitting around collecting dust, right? In like a checking account, a savings account. So what I do is I put that money in a higher yield account. So I like concrete for this, and that's spelled REIT, right? Like REIT, like real estate investment trust. So concrete. So it's clever in quotation marks. But right now they're paying 6.5% interest, and you can pull your money out at any time. That being said, it does take between 1 to 4 weeks to actually get your money back into your checking account. So you have to be a little thoughtful of timing there. It's not instantaneous the way that a savings account is. Another option is ground floor notes. So they offer a 1 month note, at least. I'm not sure if they're offering for everybody or just old stairs customers, but they do have a 3 month note as well. Their 3 month note is paying 7.25% right now, and they
Mm,
have a 1 year note and a 2 year note. But that 3 month note is a good place to just park cash if you know you're not going to need it for a couple months, um, just to earn a decent return on it. I mean, 7.25% is nothing to sneer at, right? I mean, it's not what we're aiming for here, becoming a millionaire in 10 years, but it's a great place to just stash some cash for a couple months if you know you won't need it for 3 months, and still earn a respectable return on it. And of course, diversify, right? I mean, spread your money in stocks, in real estate, maybe in bonds if you feel the need. I don't. I mean, I have various real estate investments fill that niche in my personal portfolio. I'm not saying that's for everybody, uh, but um, but spread your money far and wide. I mean, I've got money in dozens of different real estate syndications. I've got my money in a bunch of different crowdfunding platforms. I've got a lot of money in just stock index funds, right? So tracking things like the Russell
Mm,
2000 or the S&P 500.
that's important too. I mean, because especially if you're worried, is the real estate market in this sector going to tank? Well, then maybe you have something over here that's doing well, and so
Sure.
forth and so on. So I think that's very, very important
Oh yeah.
just as a
Yeah.
rule.
I mean, so I've got a little bit of money in Streetwise, which is it's a private REIT that owns some office real estate, and it has not done well over the last year or two, right? In the wake of the pandemic, but it makes up a very small percentage of my portfolio, and I still am glad that I have a little bit of money in office space real estate. I'm glad it's not a lot of money, but I mean, that's why I have a little bit of money here, a little bit of money there. Multifamily, mobile home parks, real estate secured debt. Um, I actually think now is a great time to have money in real estate secured debts. I mean, they're paying high interest, but properties have held their value pretty well in most markets around the country, despite the high interest rates. And they've been paying well. So, and it's been a relatively safe and steady source of passive income for me. Um, Private notes. I mean, I've got a couple that I've lent money to for, I don't know, 5 years now, and they've been paying me 10% interest like clockwork. So spread your money far and wide. Diffuse your risk. And like you said, Denny, maybe the tech sector of the stock market crashes this month. Maybe it's office space, commercial office space that crashes. You still have money in so many other buckets.
Other And what's nice, and I'm just, our real estate club, I've learned like about different like self-storage and um
Oh yeah,
even a
industrial.
business that we
Yeah, I mean
we
we've
were.
got a steel tank manufacturing company that we've
And
invested
it's
in.
interesting to me to learn just about, not only about the risk, but about how they run and just, yeah, diversification is definitely a passion.
Absolutely. So we have an entire table showing exactly how much you would have to invest each month at different interest or different rates of return. We will link to that. It's an article called Five Steps to Become a Millionaire in 5 Years or Less. And we also we'll link to the article on infinite returns. We will link to concrete and ground floor that we mentioned here. And we'll also link to our co-investing club. If you're interested in investing passively with small amounts of money every month in as part of a larger investment club where we vet different deals together every month. So Denny, what did we miss? Anything else that you want to tie into this conversation before we call it complete?
Um, Keep your emotions out of it.
Right.
Don't panic sell. Don't listen to the news or whoever is saying, the real estate market's going to crash or this bond or this not bonds, this stock is done and whatever, this company's going up. I just think that if you're spread well and you're diversified, you should be okay and you don't want to act out of emotion.
Absolutely. Don't panic sell and don't greed buy. Dollar cost average,
That's
just
it.
every week or every month, just keep plowing money into the market, whether that's stock market, real estate market, preferably all the above. On that note, guys, please rate, review the show if you enjoy these conversations, and we will catch you next week.